Well, we delayed today's video or this week's video until Friday to capture the data from PCE, Personal Consumption Expenditures. That is the Fed's favorite read on inflation. Not that any of that matters. We'll talk about that more in a minute. And it was fairly flat, y'all. We're going to dive into the details and see how it moved the markets today, or if it did. Today is the 27th of June, 2025. I hope you're doing well. As mentioned, PCE came in up 2.3%, so the headline number was right at expectations. The core number, however, was a little bit hotter. It was at 0.2 versus 0.1. Y'all, it's difficult to make a lot of progress with regard to year-over-year inflation reads because the numbers from a year ago were really low when we're looking at May for the PCE. So we look at these replacement values, these year-over-year numbers, and they're a little bit skewed because they don't really give the accurate picture of where we are today. But the bottom line is inflation is still pretty much at that 2% target that the Fed is looking for. And we're going to talk about that in a little more detail because Jerome Powell and some congressional testimony this last week made it clear that every indication in the economy, from jobs, the labor market strength or weakness, inflation being largely at goal, suggests that the Fed should be cutting rates, made that admission, and then further stated that tariff and trade policy are the reasons they're not. That's a stark departure for the Fed, y'all, because back in 2020 and 2021, when inflation was running rampant, they were telling the world that it was transitory, that we needed to wait and see, that it was supply chain disruption, and acknowledgement that higher prices can be due to something other than inflation. Now, inflation causes higher prices, y'all, but higher prices do not cause inflation. And he knows that, and that is important when we're discussing tariffs. We've talked about this repeatedly on this video. Tariffs may increase temporary pricing of certain products that we import, but they're not the result of inflation. And the Fed knows this. To say that the Fed is holding off because they might get a number that appears hot, and that they would have been seen cutting into a potentially hotter number that might have been caused by something that's purely transitory, like tariffs, is for them to say that anything that causes prices to increase is inflationary. They know far better than that, y'all. And here's one of the fundamental ways you know. Higher interest rates cause things to be more expensive. So they are, in effect, holding a tight monetary supply in such a way that a number of aspects in the economy are priced higher than they should be as a result. Borrowing cost weighs heavily on the cost of production. The Fed would be the first to defend that, saying that's not inflation. Well, neither are tariffs. So it's time for the Fed to move. I'm really not going to be beating around the bush about it any further. This is purely political in my view. They don't like tariffs. They don't like it from a free trade perspective, and we can have that conversation. But don't tell me that it's the result of inflationary pressures that is compelling them to not move. All right, so we got a fairly tame PCE today, slightly hot to the upside. But more importantly, y'all, we got a China trade deal today. So China has acknowledged that they have come to broad agreement with the Trump administration around trade policy. That's good news. Rare earth minerals are now being promised to be exported again. So that's good news on that front. It's not great news for the bond market, though, because you had a lot of if you had any apprehension on the equity side, these two reports go a long way towards resolving them. So you're seeing a lot of money flow into equities. You saw the Dow up was huge up earlier. It was up over 500 points earlier in the day. It's now up 184 at the time of this recording. The S&P had an all-time record high earlier today before selling a bit and pulling back a bit. So equities are liking it. That always puts some pressure on the fixed income markets, and we're seeing that. So bonds are selling off a little bit today in the face of that equity strength and in this China deal more so than the PCE number. Here's where we are with interest rates, y'all. Mortgage News Daily today has a 30-year fixed rate conforming loan at 6.72%. 1 week ago, we were at 6.86. 30 days ago, we were at 6.97. So rates are down 1/4 of a point in the last 30 days, which is a really nice reprieve, y'all. We're very happy to see that. Hopefully that will spur some more activity. I am seeing folks with a little bit of discount get deep into the lower sixes. And of course, on government loans, FHA and VA, that takes them into the higher fives in all likelihood, especially if they're willing to pay a little bit of discount. So good news all around this week. We've seen 10 days or so of bond prices increasing and interest rates coming down. So let's hope that trend line picks back up this next week after we get this kind of China trade-induced buying in equities works its way through the markets, maybe we will re-engage that trend line lower after today's hiccup. In any event, hope this is helpful for you and for your clients, folks. Good news is rates are lower than they were a month ago. Very happy to see it. Let's go sell some houses. Let me finance them for you. It's what we do for a living here. Always blessed to have your referrals. Stay safe, stay blessed, and we will talk to you next week.